Yeah, hi, good evening, Arshita.
Hi, sir. Good evening.
No one else is joining.
Yeah, no one.
So there are just three of you or just two of you?
So technically, yeah, three. But Hemant is, I mean, he never attends any of the live sessions. So
Okay.
just Amol and me, and that Amol doesn't join much.
Okay, fine. Okay, so we'll start then. So, by the way, how are your IAs?
Sir, I could not attend today 6 p.m. I had
Okay.
to, so I'll attend the one tomorrow's one. And
I
yesterday
think,
9:30 p.m. one was good.
okay. So I think you have one buffer IA, right? I mean, they take five IAs, but they take the best of four, right?
Yes, best of all. So it's okay if we miss one of them.
Fine. Okay, great. So any questions with whatever we've done till date before we move to the last session?
I don't think so. I'm good.
Okay, fine. So, okay, before we start, just let me know, did we do this question in the previous session? I think
No,
we did these three, right?
we didn't do these ones.
We didn't do these questions.
No.
Are you sure?
Yeah.
Where we looked at how much current liability is to be paid and all that.
No.
Okay, fine. Then let's go through it. So let's look at these questions. It says the ratio of current assets to current liabilities is 1.5 is to 1. So that's nothing but 6 lakh upon 4 lakh. They're saying the accountant of the firm is interested in maintaining a current ratio of 2 is to 1. By paying a part of the current liabilities, calculate the amount of current liabilities that should be paid. So let's look at the calculation. So the existing current ratio is nothing but 6 lakh upon 4 lakh. So that's my existing current ratio, which is 6 lakh upon 4 lakh, which is 1.5 is to 1. They're saying the accountant now wants this ratio to go up to 2 is to 1. And how does he intend to do that? By paying a part of the current liabilities. So he'll pay some amount of current liabilities, because of which the ratio will become 2 is to 1. The question is, what is the amount of current liabilities that should be paid? Can you try?
Yes.
Yeah.
So 1 lakh.
How much?
1 lakh.
1 lakh. Okay. So if you pay 1 lakh, what will be your current liabilities? Your current liabilities will become 4 minus 1, which is 3. So your current ratio, you're saying, will become 2. Okay. Now let's look at it. If you pay 1 lakh, your current liabilities will go down by 1 lakh. But what about the cash balance? The cash balance will also go down, right?
It's not
And
specified if the assets also contain a part of the cash balance that's included in
no,
liability.
then how will you pay the current liabilities? If you don't have cash, then how will you pay off the current liability? Which means you have enough cash to pay off that portion of your liabilities, which is included in the numerator, right?
Okay. Right.
So I have current assets upon current liabilities. Current
Okay.
assets includes the cash.
Okay.
So I'll say, okay, if I'm paying something from the denominator, that same amount will be deducted from the numerator also, which means I'll get a ratio like 5 is to 3, which is not equal to 2. But I want a ratio of 2. So how much should be paid?
Okay. So 2 lakh.
If I pay 2 lakhs,
2 lakhs. Yeah, 2 lakhs.
if you pay 2 lakhs, what will happen? Numerator will become 4.
4.
Denominator will become 2. You'll get a ratio of 2.
2.
Fine. Any doubt with question number 1?
No, sir.
Okay, let's try question number 2. They're saying current assets to current liabilities of a firm is 8 lakh is to 3 lakh. So current assets are 8 lakhs, current liability is 3 lakhs. Again, it's on similar lines. They're saying accountant wishes that the current ratio is 2:1. And how does he want to do that? By acquiring current assets on credit. Calculate the amount of current assets that should be purchased. Can you try this one?
Okay.
So if I look at my existing ratio is 8/3, which is 2.66. The accountant wants the ratio to be 2. And he intends to do that by acquiring assets on credit. So what should be the value of the current asset that should be purchased on credit? Yeah, how much?
Acquiring assets on credit, which means liability will increase.
Yeah. So I come to your shop, I don't pay you cash, I just purchase it on credit, and I just say that, okay, I'll make a payment after 30 days, 60 days, 90 days, whatever.
Okay. Okay. Got it. Is it 5 lakhs?
5 lakhs. So you will buy assets worth 5 lakhs on credit. So if you buy assets worth 5 lakh on credit, then which number is changing? The numerator or the denominator? And by how much? You are buying current assets on credit. So what will be the impact? So let's say I come to your store and I buy some inventory worth 100 rupees. And I tell you that, okay, I'll make a payment after 30 days. So for me, my company, what will happen? My current asset will also go up by 100 rupees and my current liability will also go up by 100 rupees. Right?
Okay, current asset will also go up, liability will also.
Because I'm buying current asset, right? So current asset will also go up. At the same time, current liability will also go up and they'll increase by the same amount. So again, equate it. So let's say if this goes up by x, denominator will also go up by x and this will become 2. So now solve it and tell me what's the value for x.
X is equal to 2. Current assets to be purchased.
So if you purchase assets, current assets worth 2 lakh, what will happen to the numerator? Numerator will become 8 plus 2, which is 10. What will happen to the denominator? Denominator will become 3 plus 2, which is 5. So what will be your ratio? Ratio will become 2. Yep. Any doubt with question number 2?
No.
Okay. Let's look at question number 3. They're saying a business has a current ratio of 4:1. So current ratio is nothing but current asset upon current liability, which is 4:1. A quick ratio of 1.2:1. Quick ratio is nothing but current asset minus stock minus prepaid expense upon current liability. And they're saying this is equal to 1.2. They're saying working capital is 1,80,000. Working capital is nothing but current asset minus current liability, and that is equal to 1,80,000. They're saying calculate total current assets and stock and they're saying there is no prepaid expense. So if there's no prepaid expense, my formula will change. My formula will become over here only current assets minus stock upon current liabilities. So can you tell me what's the value of the current asset that I have and stock that I have? Can you try?
So this question we did, I think, these two.
We did all three. If I'm not wrong, we did all three. We did the first three. The only doubt was whether we did the fourth one or not. That was the only, I mean, I was a little skeptical about the fourth one. I'm sure we did first three. But okay, we'll still do it. We're done with the first two. Let's try the third one again. Tell me what's the value of your current assets and the stock. If I do a cross multiplication over here, can I say that current assets are equal to 4 times current liabilities?
Yes.
Then I'll just replace. I'll say, okay, instead of writing current assets over here, I'll write 4 times current liabilities because current asset is equal to 4 times current liability minus current liability is equal to 1,80,000. So current liability will become 1,80,000 divided by 3, which is 60,000. Any questions on the current liability?
Got it, sir. Yes, sir, we did this one.
We did this, right?
Yeah.
So if your current liability is 60 and your current assets are 4 times, your current assets will become 2,40,000. And then you can calculate your stock also. Fine. Because if you know your current assets, you know your current liability, and you know that current asset minus stock upon current liability is 1.2. This is the unknown figure. This will be the balancing. You can calculate that. Fine. Yeah. Any doubt with the third one before we look at the fourth one?
No, sir.
Let's look at the fourth one. I think we didn't do the fourth one. Let's look at it.
We did both.
We didn't do?
No.
No. Okay, fine. Let's look at it. They're saying calculate current ratio and quick ratio from the following. So again, first let's look at the formulas for the current ratio and quick ratio. Current ratio is nothing but current asset upon current liability. Quick ratio is current asset minus stock minus prepaid expense upon current liability. So I need to calculate current ratio. I need to calculate quick ratio. And they've given me some information. What information have they given me? They're saying working capital is 1.5 lakh. So working capital is nothing but current asset minus current liability. And they're saying that is 1,50,000. They're saying total debt is 4 lakh. So total debt is 4 lakh. Out of which they're saying long-term debt is 3.1 lakh. So total debt will consist of long-term debt and will consist of short-term debt. So let's say if you have some loan, you could have either a short-term loan or a long-term loan. So total debt will consist of long-term debt and short-term debt. And they're saying long-term debt is 3,10,000. So how much will be your short-term debt?
3,01,000. So 90,000.
90,000. If total debt is 4, out of which 3.1 is long-term, which means balance 90,000 is short-term. Any doubt till here?
No, sir.
Then they've given me stock as 1,10,000, prepaid expense as 10,000. So I know the value of stock. I know the value of prepaid expense. If I can calculate my current assets and current liabilities, Then I'll get my current ratio, I'll get my quick ratio. So let's look at how do I get the value of current asset and current liability. This short-term debt, is it a current liability or a long-term liability?
Current.
Current liability. So it's a current liability. Fine. Do I have any other information about any other current liability like creditors or anything else? In the question, have they given me any other information about any other short-term liability?
Paid expenses. Prepaid expenses.
Prepaid expense is a current asset.
Asset, right?
It's a current asset.
Stock.
Stock is a current asset. That's your inventory.
Asset, right? No, nothing else.
Nothing is given, which means the only current liability that I have is my short-term debt, which is 90,000. So I'll say, okay, current liability is 90,000. Current liability is 90,000. So current asset minus current liability is 1,50,000. So how much will be your current asset? Current asset will become 1,50,000 plus 90,000, which is nothing but 2,40,000. Any doubt with the current asset of 2,40,000, this number?
Okay. Yeah.
Sure?
No, sir.
Or
Yeah.
you want me to explain it again?
So once more.
Once more? Okay. So my current liability is 90,000. So I'll say, okay, current liability is 90,000. I know my working capital is 1,50,000. Working capital is nothing but current asset minus current liability, and this is 1,50,000. Now, if this is 1,50,000, current liability is 90,000. So how much will be your current assets? Current asset will be nothing but 1,50,000 plus 90,000, which will make it 2,40,000. Yeah. Any doubt with this 2,40,000?
No, sir.
So if my current asset is 2,40,000, I know my current liabilities. I can calculate my current ratio. Again, over here, my current assets are 2,40,000. Current liability is 90,000. I know my stock. Stock is given as 1,10,000. And prepaid expenses 10,000. So you know all the numbers. You can calculate your quick ratios. Any doubt with the quick ratio or the current ratio? Question number 4. Yeah. Any questions on this?
0.9. Okay. No, sir.
Sure. Okay. Then just let me know if you've done a question like this on cash flow statement.
So let me check.
I mean, as far as I remember, we haven't done it because the one that we discussed in the previous session was a very simple one where I just told you how to calculate and make a cash flow statement. I don't think we had a balance sheet or asset something.
Yeah, we did.
Okay, fine. So we'll look at this and then we'll move to the remaining topics for today. So let's look at the cash flow statement. Now, they've given this data and they're saying make a cash flow statement. They've given the data for 2 years. So again, over here it's 15-16. We can assume it's 21-22. So they've given data for 15-16. They've given us the balance sheet. I have share capital. I've got debentures, provision for bad and doubtful debt. So what's a provision for bad and doubtful debt? Let's say I sell goods to you and you buy goods on credit. Okay, but I feel that no, there's a possibility that you may not pay the entire amount. So what I do is I create a provision, I set aside some amount of money so that in case you don't pay it, I'll not get that much of a hit. So this amount which is set aside for future anticipated losses because the customer may not pay is known as provision for bad and doubtful debt.
Okay.
Then I've got creditors, that's nothing but my supplier. And this is my profit and loss account. That's nothing but my reserves and surplus. Then I've got cash balance, I've got debtors, I've got stock, I've got land, and I've got goodwill. And they've given me additional information saying that dividend paid is 3,500, land purchase is 10,000, amount provided for amortization of goodwill is 5,000, and debentures paid is 6,000. Now, again, I'll just try to minimize this. Is it visible?
Yes, sir.
Okay, fine. So when I look at a cash flow statement, typically what I have in a cash flow statement is I have three things. One is I've got cash from operating activities, I've got cash from investing activities, and I've got cash from financing activities. So let's go line by line. Let's look at share capital. Share capital is nothing but the money which has been raised by the company by issuing shares. So I'm saying last year my share capital was 70,000. This year my share capital has become 74,000. So can you tell me what has happened during the year? Last year it was 70,000. This year it is 74,000. So what has happened during the year?
Share capital has increased.
Okay. So share capital, if it increases, which means what will happen to the company? Will it result in an inflow of cash or outflow of cash for the company?
Inflow.
Inflow. So company has raised money by issuing shares. So let's say you are a shareholder. Let's say a company like Google. I come and issue shares to you. You subscribe to my shares. You pay me the money. So my capital goes up from 70,000 to 74,000. Now, when a company issues shares and they raise money, is this money that they're raising, is it from their day-to-day operating activities? Is it an investing activity or is it a financing activity? Financing activity, because money coming in and going out because of shares, debentures, and everything, it's a financing activity. So I'll say, okay, you've raised money by issuing shares worth 4,000. So this 4,000 I'll capture as an inflow in my cash from financing activities. Any doubt till here?
Yes, sir.
Fine. Then let's look at the next one. Let's look at debentures. Debentures were 12,000, but at the end of the year, I'm saying it is only 6,000. So what has happened during the year? I've repaid the debentures. It's like a loan. So I had a loan worth 12,000. Now my loan balance is only 6,000. So what has happened during the year? I've repaid the loan. So when you repay the loan, from the company's point of view, is money coming in or going out for the company when the company repays the loan?
Going out.
Going out. So again, it's a financing activity. So I'll say, okay, debentures paid off worth 6,000. So I'll show it as a part of financing activity. Debentures have been paid off worth 6,000. So when money goes out, either you can show it as a negative sign over here, or you can just write less over here. Similarly, if it's a positive sign, then I'm just writing add over here, or you can just write a positive number over here. That's fine. Any doubts with these two transactions?
Yes.
Then let's look at the next one. The reserve that you've created for bad and doubtful debts, it's nothing but a current liability. Again, if you remember in the previous session, we discussed increase in current liability. Is it an inflow or outflow of cash?
Increase in current liability is inflow.
Inflow of cash. So over here, what is happening? My current liability is from 700, which is this provision for bad and doubtful debt, from 700 has gone to 800, which means it's nothing but an increase in current liability. And an increase in current liability is nothing but an inflow of cash. And this is from your day-to-day operations. So I'll take it as a part of cash from operating activities. I'll say increase in provision for bad and doubtful debt, 100 rupees. It's an inflow of cash. So you will show it as a positive number. Any doubt with the provision for bad and doubtful debt?
So why would they even give the debt if they're doubtful?
Why would they?
I mean, the provision for doubtful debt, right?
Yeah.
So if they already know that uh, a particular debt is risky, why would
No. So for example, let's say you come to my shop and you buy goods worth 10 lakhs. Okay. And I've sold the goods to you on credit saying that, okay, you make a payment after 6 months. Now, when I sold goods to you, I mean, there was no information that you're facing some problem in your business or something. But 2 months down the line, I get to know that your business is not doing that well. So now I'm a little skeptical that you may not be in a position to pay entire 10 lakhs. And looking at your past track record, looking at other people with whom I am dealing in the same business, I feel that maybe 5% will be the amount that I'll not be able to collect from you. So 5% of 10 lakhs is nothing but 50,000. So I'll create a provision worth 50,000 in my books. So it's not that I created a provision initially only. If I would have created a provision, which means then in that case, my sales would not be 10 lakhs and it's not a provision then. It's actual loss for me. This is an anticipated loss. So I'm saying that, okay, I'm expecting that you may default to the extent of 50,000 and instead of paying 10 lakhs, you will pay me only 9.5 lakhs.
Okay, and this is deducted from current assets.
This is deducted from current assets from your debtors, which means now I'll say my debtors are not worth 10 lakhs. My debtors will be 10 lakhs minus 50,000, which is 9 lakh 50,000. Or alternatively, I'll show debtors worth 10 lakhs on the asset side and provision for bad and doubtful debt worth 50,000 on the liability side. It is still the same. Yeah. Any doubt till here?
Yes.
Okay, fine. Then let's look at creditors. Creditor is a current liability. Again, increase in current liability is taken as a source. That's an inflow of cash. So again, I'll go to my operating activities and I'll say, right, increase in creditors 1480. That is nothing but an inflow of cash. So any doubt with creditors?
Yes.
And I have my profit and loss account. My profit and loss account was 10,040. At the end of the year, it is 10,560. So my opening profit was this much, closing is this much. So what's the profit that I've generated during the year? 10,560 minus 10,040, which is nothing but 520. So that's my profit for the year, which is my starting point for calculating my cash from operations. So my profit for the year is 520. Any doubt with 520?
Yes.
Fine. Then let's look at the cash and bank balance. Cash and bank balance is given as 9,000 and 7,800. So this I show at the end. So I'll take my opening cash balance as 9,000 and closing cash balance as 7,800. So whatever is my cash balance or bank balance at the beginning and at the end of the year, I'll show it at the end as my opening cash and bank balance and my closing cash and bank balance. Then let's look at the other current asset that I have. I've got debtors. Debtor is nothing but a current asset. An increase in current asset is an inflow or outflow of cash. If you an increase in current asset is an inflow of cash or outflow of cash. Let's say you go and buy stock. Stock is a current asset and you pay money. So will your cash balance increase or will your cash balance go down?
Outflow of cash.
Outflow. So increase in current asset is an outflow. So I'll say, okay, my debtors have gone up, which is taken as an outflow. So I'll say, okay, increase in debtors, I'll take it as an outflow. So instead of writing a negative number, I've just written less over here. So this is number of 2,800 is nothing but the difference between your opening and your closing debtor balance. So any doubt with debtors?
No, sir.
Then let's look at stock. Stock is another current asset. Now, if there's a decrease in current asset, you will take it as an inflow or outflow of cash.
Yes.
I didn't get you. What did you say?
No, sir, I was just
Okay.
decrease in current asset.
You'll take it as an inflow or outflow of cash.
Decrease asset outflow.
Okay, let's take an example. Let's say you got stock worth 10,000 and you sell that stock and now you have got zero stock. So when you sell stock, money comes in or money goes out?
Comes in.
Comes in. So over here, it's the same thing. You had stock worth 49,200, but now you have stock worth only 42,700, which means you have sold some stock. Now, when you sell stock, money will come in. So a reduction in current asset is to be taken as an inflow of cash. So I'll say, okay, decrease in stock is nothing but an inflow of cash. So the stock figure has changed by 6,500 from 49,200. It has become 42,700. So this is nothing but a decrease in stock, which is an inflow of cash. Any doubt with stock?
Yes.
Then let's look at the land value. I had land worth 20,000 and at the end of the year, I'm saying I've got land worth 30,000. So what do you think has happened during the year?
Purchase of land.
I purchased land worth 10,000. So when you purchase land, money will come in or go out?
Go out.
Go out. And is it an operating activity? Is it your day-to-day business to buy and sell land?
No.
No. Is it a financing activity? Are you raising money, equity or debt or something? No, which means it will be a part of investing activity. So I'll say, okay, I'm purchasing land worth 10,000 and it's an outflow for me. So either you write a minus sign over here or you just write less over here. Okay. Any doubt with the purchase of land worth 10,000?
No, sir.
Fine. Then let's look at goodwill. Goodwill is an intangible non-current asset. Goodwill was worth 10,000 in my books, and at the end of the year, it is worth 5,000 in my books. So what has happened? You've written off goodwill worth 5,000. Now, when you write off goodwill, what will happen? I'll say P&L to goodwill account. So my goodwill is going down. So it is reducing my profit, but it is not impacting my cash. So reduction in goodwill is nothing but it is a non-cash transaction which has reduced your profit. So it's a non-cash transaction. So what will I do? I'll reverse the transaction. I'll add back the amortization or writing off of goodwill. So goodwill written off over here from 10,000, it became 5,000. So this difference of 5,000, I'll add back over here. Amortization of goodwill. Any doubt with this before we look at the balance information?
So can I take this a 2 minutes break?
Sure, sure, sure. If you want me to explain it again, I'll do that.
No, sir, I'm fine. Just I'm a little unwell, so not so speedy.
Okay.
Sir, I'm back.
Okay. So let's look at the other information. Now let's start with 4, 3, 2, and then we'll move to 1. Debentures paid 6,000. We've already taken care of that. So debentures were 6,000 have been paid. So this information is already taken care of. Then point number 3, goodwill amortization. Again, we've taken care of that. So we can ignore it. Land purchase for 10,000. So we have taken care of that. The only information that is relevant over here is nothing but dividend paid worth 3,500. So when you pay dividend, one impact is in the income statement, the other impact is in your cash balance. So you're paying dividend. So will your cash balance increase or will it go down?
Go down.
Go down. So my cash balance will go down, and it's nothing but a part of financing activity. So I'll write dividend paid worth 3,500. So dividend paid worth 3,500. My cash balance is going down. So I've taken care of this part where the cash balance is going down because of dividend. At the same time, when I'm paying dividend, it is also impacting my profit. Now, paying dividend, is it a part of your operating activity? No, it's a part of financing activity. But when you paid this dividend, this has impacted the profit. So you got a profit of 520, and this was after paying that dividend. So your profit has gone down because of this dividend, which has got nothing to do with your day-to-day operational activities. So you will say, okay, reverse the transaction. If my profit has gone down, I will add it back. So I'll add back my provision for dividend, which is 3,500.
Okay.
Now, once you've taken care of all the numbers, then you just have to add it up and get your answer. So if you total it up, what will be your cash from operations? Your cash from operations will be the sum total of all of this, which is 14,300 positive number. Cash from investing activities will be a negative 10,000. And cash from financing activity will be a minus 5,500. So you're saying during the year, you've generated cash worth 14,300 from your day-to-day operations. You've spent 10,000 for investing activities, and you spent 5,500 on financing activities, which means during the year, you have an outflow of minus 1,200. That's 14,300 minus 10,000 minus 5,500. So during the year, the cash flow generated is minus 1,200. You had an opening balance of 9,000, from which if you spend 1,200, what will be your closing balance? Your closing balance will be 7,800. Any doubt on the cash flow statement?
No.
Okay, fine. Then let's start with today's session. So if you look at today's session, we are supposed to do the remaining ratio, which is your turnover ratio. So we are already done with the liquidity ratio. We are done with solvency ratio. We are done with profitability ratio. So let's look at the turnover ratio. So in turnover ratio, in your course outline or in the async content, what they've done is they've given you these efficiency ratios or turnover ratios, which is your fixed asset turnover ratio, total asset turnover ratio, debtors turnover ratio, inventory turnover ratio. Over here, maybe we can include one more, which is your creditors turnover ratio. So maybe we'll include one more, which is your creditors turnover ratio. So let's look at fixed asset turnover ratio. Now, fixed asset turnover ratio is nothing but sales upon fixed asset. So let's say I have assets worth 100 and I'm generating sale worth 350. So my ratio will come as 3.5. It tells me that for every 1 rupee of fixed asset that I have, I can generate a sale of 3.5 rupees, or my sales are 3.5 times my fixed assets. So let's say this is company X. I've got another company Y, which has a fixed asset turnover ratio of 2.8. Which one do you think is more efficient, company X or company Y? X is more efficient because for every 1 rupee, they can generate a sale of 3.5. Whereas Y, for every 1 rupee of investment, they are able to generate a sale of only 2.8. So X is more efficient compared to company Y. Similarly, you can have a total asset turnover ratio. In case of total asset turnover ratio, the formula will become sales upon total assets. Here the formula was sales upon fixed assets. Here it will become total assets. Again, let's take similar numbers. Let's say over here I'm getting 4, here I'm getting 2.1. So company X is more efficient compared to company Y. Any doubt with fixed asset turnover and total asset turnover?
So, what's the difference between fixed asset and total asset?
Fixed asset and total assets. Again, let's take an example. Let's say this is my balance sheet. So in my balance sheet, I'll have non-current assets. I'll have current assets. And then I'll have my share capital. I'll have my reserves and surplus. And let's say I've got some debt. Non-current assets are, let's say 500. Current assets are, let's say worth 200. So my total assets are 700. And let's say this is fixed asset. So my total asset is 700, but my fixed asset is only 500. So fixed asset will be a subset of your total asset.
Non-current assets are fixed.
No. So yeah. So non-current asset is your fixed asset. Okay. Fine. Then you can have current asset turnover ratios. So you can have ratios which deal with current assets. So we looked at fixed asset turnover ratio. So now they're saying you can have ratios which deal with current assets. So you could have a debtors turnover ratio. You could have an inventory turnover ratio. So when I'm looking at debtors turnover ratio or inventory turnover ratio, let's look at debtors turnover ratio first. Debtors turnover ratio. Debtors turnover ratio is nothing but credit sale upon my receivables. So I'll take credit sales and I'll divide it by receivables, which is nothing but my debtors, bills receivable, all of that. Okay. So what does it basically tell you? So again, let's take an example. Let's say I tell you that during the year, I've got credit sales of 365 crores. And in the entire year, the number of days that I have is also 365. So what is my credit sale per day? If credit sales for the year are 365 crores, that's credit sale per annum, 365 crores. Number of days in a year is 365. So what will be your credit sale per day?
1 crore.
1 crore. Which means every day somebody comes to your shop and buy goods worth 1 crore. So I'm making a timeline. So this is day 1. This is day 2, 3, 4, 5, 6, 7, 8, so on and so forth. So every day somebody is coming and buying goods worth 1 crore on credit. Now you get in touch with your accountant, you tell him, tell me what are my average debtors, which means at any given point of time, during the year, on an average, what is my debtor value? What is the total amount pending from my customers at any given point of time throughout the year? So he'll go through the books of accounts, he'll do the calculation, and let's say he comes up with a number of, let's say 5 crores. So accountant is telling that at any given point of time, you have debtors worth 5 crores. So you have customers who haven't paid you 5 crore rupees. So again, let's go back to this timeline. If I come to your shop and I buy goods worth 1 crore and I don't make a payment to you, I'll make a payment after a few days. So what will be your debtor value? 1. Then again, someone comes and buys goods on the second day worth 1 crore. So what will be the debtor amount? it will become 2 crores now. And again, somebody buys goods worth 1 crore on credit, but they haven't made the payment. So what is the total amount outstanding from the customer? It will become 3, 4, 5, 6, 7, 8, so on and so forth. Any doubt with the debtors figure?
No.
No. But your accountant is saying that on an average, debtors are worth only 5 crores, which means this is 5, this is 5, this is 5. It's not becoming 6, 7, and 8. So again, let's look at what's happening on the 6th day. On the 6th day, somebody is coming and buying goods on credit, which means technically debtors should become 6 crores. But your accountant is saying, no, debtors are worth only 5 crores. Can I say that debtors are worth only 5 crores, which means this person who had bought goods on the first day, he is making a payment over here. Because if he is making a payment, then what is the total amount outstanding from your customers? 1, 2, 3, 4, 5. Fine. Now, if this person who had purchased goods on first and is making a payment on 6th, what is the credit period that you've given? This person buys goods on first, so you've given a credit period of 1 day, 2, 3, 4, 5. So you've given this person a credit period of 5 days, which is nothing but your debtors collection period.
Got it.
Okay. So debtors collection period, we did it in the earlier session, in the last session. So debtors collection period is nothing but the time that you give so that your customers can make a payment to you. Okay. Now let's look at the linkage between debtors collection period and debtors turnover ratio. Let's try and understand the linkage between the two. Debtors collection period is nothing but 365 days divided by debtors turnover ratio. So my debtors collection period is nothing but 365 days divided by debtors turnover ratio. And how do I calculate debtors turnover ratio?
365.
Debtors turnover ratio is nothing but credit sales upon your receivables. We looked at over here. So debtors turnover ratio is nothing but credit sales upon your receivables. Which means if I expand this number, what will I get? I'll get 365 divided by credit sales into your average debtors or receivables. So if I go back to this data, what are my credit sales for the year? My credit sales for the year is 365. At any given point of time, what are my receivables? My receivables are nothing but 5. So what will be my debtors collection period? My debtors collection period will come as 5 days. And this is what we found when we are using this timeline also. That my debtors collection period is 5 days. So if your debtors turnover ratio is high, your debtors collection period will be low, and vice versa. So there's an inverse relationship between your debtors turnover ratio and your debtors collection period. So debtors collection period tells you how quickly your customer is making a payment to you. So if your debtors collection period comes as 30 days, you're telling me that your debtors will make a payment in 30 days. If your debtors collection period is 60 days, which means your customer will make a payment to you in 60 days. So if your customer is making a payment to you in 60 days, and let's say I've got 360 days in a year. So the customer will come, buy goods, make a payment. Then again, he'll buy goods. Again, he'll make a payment. Then again, he makes a payment. He makes a payment, makes a payment, makes a payment. Which means how many times is that customer turning around in the year? He's turning around 6 times. That is nothing but my debtors turnover ratio. So debtors turnover ratio basically tells you how many times your debtors are turning around in a year. So in this case, if my customers are making a payment to me in 60 days, which means my debtors are turning around 6 times in a year.
Got it.
So any doubt with the debtors collection and the debtors turnover and the linkage?
No, sir.
So as a company, do you want your customers to make a delayed payment or you want your customers to make the payment quickly? Quickly, which means what is it that you want? You want your debtors collection period to be low, which means as a company, you would want your debtors turnover ratio to be high. So companies want debtors collection period to be low and debtors turnover ratio to be high. So if I get a customer who's ready to make a payment in 10 days compared to another one who's ready to make a payment in 30 days, I'll prefer to sell it to the first customer and not to the second customer if I have an option. Yeah. Any doubt with debtors collection and debtors turnover?
No, sir.
Now, let's say you've done the calculation and you get a debtors collection period of 30 days. Then what do? Is it good, bad? How will you identify? Or you're fine with this credit period of 30 days? How do you identify whether it's good or bad? So this 30 days is the time which is taken by the customer to make a payment to you. So how do you identify whether it's good or bad?
You have to compare it in relative to what's the average DCP.
So the first thing is I look at an industry average. So I look at industry average. So I'll say, okay, in the industry, everyone is making a payment in 33 days. So is it good or bad?
Good.
Good. So whenever you calculate your debtors collection period, again on a standalone basis, it will not help you. You'll have to compare it and see what is the debtors collection period for your competitors, for your peers. So if their customers make a payment in 33 days, but your customer is making a payment to you in 30 days, then you are in a better off position compared to your peers. So that's one thing. Second, also look at the trend. Let's say 2 years back, the customers were making a payment to you in 27 days, then it became 29 days, and now it has become 30 days. Now, what's your opinion?
Now it's not good.
Now, fine. I mean, I'm still better off than the industry because I'm still collecting it in 30 days, but something needs to be looked into. And I need to get in touch with my marketing team, the recovery team, as to why this delay is happening. Initially, if I was recovering my money in 27 days, now why is it gone up by 3 days? So I'm still better off, but there are things which need to be looked into. Okay. So whenever you calculate a debtors collection period, look at what's happening in the industry and look at what's happening within the company. So this is like an inter-firm and intra-firm analysis.
But sir, is this information of these ratios and peers and competitors publicly available?
Yeah, so there will be databases from which you can do the calculation. So you will not get the data directly saying that debtors collection period is 30 days. You'll have to calculate it. So how will you calculate it? I'll take 365 divided by debtors turnover. Debtors turnover ratio is nothing but credit sales upon debtors. From where will I get credit sales? From the income statement. From where will I get my debtors figure? From the balance sheet. So using this, I'll calculate my debtors collection period. So let's say I'm company X. I'll do the same thing for company Y and Z, and I'll get an industry average, and then I'll compare my number with the industry average. Okay. Any doubt with debtors collection period?
No.
Fine. Then let's look at the next one, which is inventory turnover ratio. So you had inventory turnover ratio. Some people also call it as stock turnover ratio. So again, it's on similar lines. So let's look at inventory turnover ratio. Inventory turnover ratio basically talks about how quickly your stock is turning around and you're able to get rid of it and sell it off. So inventory turnover ratio basically tells you how quickly you're able to get rid of the stock from the shelf, from the godown, and you're able to sell it to the customer. Let's take an example. Let's say I've got two companies, X and Y. Company X keeps the goods in the godown for 60 days, and then somebody comes and buys the goods. Company Y is able to sell the goods in 49 days. Which company is better, X or Y?
Why?
Why? Because they are able to sell the goods in 49 days. This company struggles and they are able to sell the goods in 60 days. So this is nothing but your inventory holding period. So inventory holding period for company X is 60 days, company Y is 49 days. How will I link inventory turnover ratio to inventory holding period? Inventory holding period is nothing but 365 divided by inventory turnover ratio. So just like you had over here debtors was linked to debtors turnover, debtors collection is linked to debtors turnover. What you have over here is inventory holding period is linked to inventory turnover ratio. So as a company, do you want your inventory holding period to be high or low?
Low.
Low. So if you want your inventory holding period to be low, then what should happen to your inventory turnover ratio? It should be high or low?
High.
It should be high, which means again there is an inverse relationship between inventory holding period and inventory turnover ratios. So again, if you look at all these outlets, for example, you go to Marks and Spencer, Zara's, and all these retail outlets, they don't want the goods to lie on their shelf for months and months. They want the goods to be produced. It should come on the shelf and should move out as quickly as possible. So they want the inventory holding period to be low, which means they want the goods to go out of the shelf as quickly as possible. So inventory turnover ratio basically tells you how quickly you are able to get rid of your goods. And it is inversely proportional to the inventory holding period. Now, how do you calculate your inventory turnover ratio? Inventory turnover ratio is nothing but cost of goods sold divided by stock. So if I expand it, inventory holding period will be nothing but 365 divided by COGS into stock. So that's my inventory holding period.
So stock means?
Stock means your inventory.
Inventory, right?
Inventory.
Got it.
Okay. Again, the same thing. What you'll do over here is you'll compare your inventory holding period with the peers, and you'll also look at what's happening within the company. So let's say my inventory holding period is 60 days and I'm X Limited. My competitor is 50 days. So I'm saying, okay, there's a problem. I'm still struggling. I still hold my inventory for 2 months, whereas my competitors are able to sell it off in 50 days. But I also give you additional information. And I say that it was 75 days, then it became 70 days, and now it has become 60 days. So now what's your opinion about the inventory holding period of your company? So 2 years back, it was 75 days. You're holding the inventory for 2.5 months. Then you're holding it for 70 days. And this year, now it has become 60 days.
It's good. Getting better.
Yeah, it's getting better. There's improvement, but still a lot of things need to be changed. So things are improving, but you're still lagging as far as your competitors are concerned, because they can sell it off in 50 days. You're able to do it in 60 days. So you're improving, but more things have to be done. Okay. Any doubt with inventory holding period, inventory turnover? Similarly, debtors collection period, debtors turnover.
Yes, no.
Similarly, we'll just link one more thing, which is creditors. So creditors payment period, and how do you link it to your creditors turnover ratio? Creditors payment period is nothing but 365 upon creditors turnover ratio. So creditors payment period basically tells you how much time do you take to make payment to your suppliers. So as a company, do you want to make a payment to your supplier today, or do you want to delay the payment and make the payment after 30 days, 60 days, 90 days as a company?
Delay.
You want to delay it, which means as a company, you want your creditors payment period to be high. So if your creditors payment period is supposed to be high, what should happen to your creditors turnover ratio?
It should be down.
It should be low. So again, there's an inverse relationship. You want to make a payment after 90 days instead of making a payment, let's say after 2 days or 3 days, because you want the cash to be with you rather than being with someone else. So if your creditors payment period is supposed to be high, then your creditors turnover ratio has to be on a lower side. And how would you calculate your creditors turnover ratio? Creditors turnover ratio will be nothing but credit purchase upon your creditors and bills payable. So in a nutshell, this is known as payables. So just like in debtors, the denominator was receivables, over here I'll have payables. So if I just expand this, it will become something like this. It will become 365 upon credit purchase into payables. So that's how you calculate your creditors payment period. Again, once you calculate your creditors payment period, and let's say your period, your X Limited, you are making a payment in 90 days. But when you look at your peers, they are making a payment, let's say average for the industry is 100 days. Which means you're still making a payment quickly to your supplier compared to your peers. They are taking 100 days, you're making a payment in 90 days. So again, there is a scope that you can delay it and make a payment in 100 days. So you'll have to figure that out. Why is it that you are not exploring that option of making a payment in 100 days? Why is that you're making a payment in 90 days? So again, compare the number with the industry norm and also look at what's happening within the company. Look at the trend analysis. So any doubt with your creditors payment period and your creditors turnover ratio?
No.
Okay. So any doubt with the turnover ratios? So we're done with fixed asset, we're done with debtors, inventory, creditors, and we're done with total asset turnover ratio. Any doubt till here?
No.
We'll do DuPont and then we'll take a break. Okay.
Okay.
Fine. Let's look at DuPont analysis. Any idea what's a DuPont analysis?
No, sir.
So let's look at a DuPont analysis. DuPont analysis is nothing but an extension of your return on equity. So it basically talks about the factors that influence return on equity. So first, how do I calculate return on equity? Return on equity is nothing but profit after tax upon shareholders fund into 100. So this is how I calculate my return on equity. So if I want to expand this and look at the factors which affect my return on equity, this entity DuPont, which was an American based company, they did an analysis and they said there are 3 factors which can influence your return on equity. So they said there are 3 factors which can influence your return on equity. Let's look at those factors. First one is your net profit ratio. So net profit ratio is one factor which will influence your return on equity. Then you have your total asset turnover ratio. So total asset turnover ratio is another factor which will influence your return on equity. And the third one is equity multiplier, which talks about how much debt you have in your company. So according to this DuPont analysis, return on equity is nothing but net profit ratio into total asset turnover ratio into equity multiplier. How do you calculate your net profit ratio? Net profit ratio is nothing but net profit, which is PAT, upon sales into 100. So that's how you calculate your net profit ratio, which is profit after tax divided by sales into 100. How do you calculate your total asset turnover ratio? We did this today. Can you help me and tell me how do we calculate total asset turnover ratio? Total asset turnover. Turnover is nothing but sales. So what will be the formula?
Total asset by sales.
No, it's the reverse. It's sales upon total
Sales
asset.
by total asset, yes.
So total asset turnover ratio is nothing but sales upon total assets. And if I look at your equity multiplier is nothing but total asset upon shareholders fund. So now if I multiply these, what will happen? Sales and sales will nullify each other. Total asset will nullify each other, which means effectively, what's the formula that I'll get? Profit after tax divided by shareholders fund into 100, which is nothing but this.
Okay, got it.
Okay. So DuPont analysis says there are three factors. The first one is how profitable you are, which gets captured by your net profit ratio. Second one is how efficient you are. So this talks about how profitable you are, which is captured by your net profit ratio. Second one is how efficient you are, which gets captured by your total asset turnover ratio. And the third one talks about debt, whether you've taken any debt in your company, which gets captured by your equity multiplier. So return on equity can be increased if you take debt, or if you are an efficient company and you're able to generate more sales on a lower investment base, or if you're a profitable company and you're able to control your cost. So three things can influence the return for the equity shareholders: how profitable you are, how efficient you are, and whether you're taking debt or not. Now, let's say, any doubt till here before I look at a hypothetical example?
Sir, EM should be low or high?
No, again, that will depend. For example, let's say if I'm an infra company, an infrastructure company, steel company, cement company, all these companies will have a high debt. They'll have a lot of debt. Compare this to an IT company, an IT company will have low debt. So if I'm an IT company and my equity multiplier is low, then to generate high returns for my equity shareholders, what should happen? I should be highly efficient and I should be in a position to control my cost. Okay. So if one thing is not in my favor, the other two things should be in my favor. Now, if you're a fundamentally strong company, then you should have a high net profit ratio, a high asset turnover ratio, or should you have a high debt to increase the return for your shareholders? If you are a fundamentally strong company, means you have a solid business model and you want to generate good returns for your shareholders, should you take more debt and increase the return, or should you control the cost and be more efficient and increase the return?
Should be more cost efficient.
Cost and efficient. So if I'm a fundamentally strong company, then I should focus on these two. So fundamentally strong companies which have solid business models, they will try to be more profitable, they will try to control their costs, and they'll try to be more efficient. But if I'm a company which does not have a solid business model, I'm not more profitable, I'm not able to manage my assets properly, I'm not efficient, but still I want to give returns to my shareholders, high returns, then what will happen? I'll try to take more debt. Let's take an example. Let's say I've got company X, I've got company Y. Company X has a net profit of 10%, an asset turnover of 2, and an equity multiplier of 1, which means what is the return on equity? The return on equity is 20%. Company Y also has return on equity of 20%, but look at how they're doing it. Their net profit ratio is 5%, asset turnover ratio is 1, and their equity multiplier is 4, which means when I'm looking at profitability at the profit level, I'm not a great company. When I'm looking at efficiency, I'm not a great company, but still I can give you the same return from a company which is fundamentally very strong. And how am I able to do that? By taking more debt, which means I'm a risky company. I'm taking more debts and I'm fundamentally not very strong, but still I can give you similar returns compared to another company. But again, this is a very risky situation.
Yeah.
So if I have two companies giving me the same returns, I'll still prefer X over Y because X is a fundamentally stronger company compared to Y.
Yes.
Okay. Any doubt clear? Otherwise, we'll take a break.
No doubts.
Okay. And let's take a break. It's 8:15. Let's resume at 8:30.
Okay.
let's resume. So this is a question which is based on your DuPont analysis, where they're saying that this company XYZ Limited has maintained a stable and relatively high return on equity of around 18% for the last 3 years. And they're saying using DuPont, analyze and decompose this ROE into the 3 components and comment on the trends and the company's performance. So I'll need your help for the calculations over here, Shrikant. So let's look at the DuPont analysis. So in DuPont analysis, I have 3 ratios. The first one is your net profit ratio. So we'll first calculate your net profit ratio. Then I need a total asset turnover ratio. And then what I need is equity multiplier. Net profit ratio is nothing but net profit upon sales into 100. Total asset turnover ratio is nothing but sales upon total asset. And equity multiplier is nothing but total asset upon shareholders fund. So let's try and calculate it. So we'll do the calculation for 3 years. So we'll do it for 17-18, 18-19 and 19-20. So let's calculate the net profit ratio. How do you calculate net profit ratio? It's net profit upon sales. So my net profit is given, sales is given. So tell me what's your net profit ratio for 17-18, 18-19, 19-20. So take 21.5 divided by 305.
Into 100, right?
Into 100, yeah.
So 7%.
7%, okay. Yep. Then just make it, let's say, 1 decimal or something, because the numbers, if they're very close, then it will become difficult for interpretation.
7.01.
7.01, okay. Then how much is it for the next year, 18-19? 22.3 divided by 350.
6.37.
6.37. And for the last year?
5.34%.
5.34%. So we're done with net profit ratio. Then let's look at the total asset turnover ratio. How do you calculate total asset turnover ratio? Total asset turnover ratio is nothing but sales upon total assets. So sales is nothing but this and assets are this. So I'll get my total asset turnover ratio, which is nothing but 305 upon 230. How much is it for the first year?
This one is not into 100, right?
No, it's not into 100, no, directly.
So 1.5.
1.5, okay. Then for the next year, 350 upon 290.
1.20.
And the last year, 410 upon 350.
1.17.
1.1. Okay, fine. Then let's look at equity multiplier. That's nothing but total assets upon shareholders fund. So I have my total assets and I have my shareholders fund. So let's do the calculation for the 3 years. So for the first year, it will be 230 upon 30, 230 upon 119.
1.93.
1.93. Then for the next year, it is 290 upon 124.
2.33.
And for the last year, it is 350 upon 126.
2.7.
0.7. Okay. And if you multiply, then they're saying on an average, you're getting a return of approximately 18% year on year. So for the last 3 years, the company is giving a return of 18%. But tell me, what is happening with the profitability? Is your profitability increasing or is it going down?
Going down.
So companies' profits are going down, which means they're not able to manage the cost properly. The costs are increasing. Let's look at the asset turnover ratio, which talks about efficiency. Is the company's efficiency increasing or is it going down? From 1.5, it becomes 1.2, then it becomes 1.1, which means efficiency is also going down. So company's profitability is going down, company's efficiency is going down, but still it is able to maintain the return. And how is it able to do it? By taking debt. Because look at what's happening to your debt. Initially, your equity multiplier was 1.93, then it became 2.3, then it is becoming debt, which means you're taking more and more debt to maintain the return for the equity shareholders. So you, as a company, you're becoming much more riskier. Fundamentally, you're a weaker company, but still you're able to maintain the returns by taking more and more debt. Okay. So again, if someone says, do you think this company is a great company? The answer would be no. Over the last 2 years, the company's fundamentals have gone for a toss and the company is able to give you the same returns by taking more and more risk. Okay. Any doubt with this question? Okay. So we are done with DuPont analysis. Fine. Then let's look at a question on ratios. You have this sheet with you, the ratio sheet?
It should be there in the drive. So.
Yeah. So are you downloading it or should I just start?
You can start, sir. I will download it.
Okay, fine. So let's look at it. So they've given the balance sheet for Amar Limited as on 31st of March. And they've given the liabilities, which consist of your equity share capital, retained earnings, debentures, creditors, bills payable, other current liabilities. Then on the asset side, I've got land and building, cash, debtors, and stock. Then they've also given me the income statement. Income statement talks about credit sale. It talks about cash sale. Then it talks about the cost of goods sold, which consists of your material cost, wage cost, your production cost, the cost incurred in the factory, and finally, what's your gross profit. Then they've given us selling and distribution expense, administrative expense. I get my earnings before interest and tax. Then they reduce the interest cost. I get PBT. Reduce tax. What I get is PAT. Then what they've done is they've given me some numbers for the industry. They've given me asset test ratio, which is nothing but your quick ratio. Then they've given me receivables turnover ratio, which is nothing but your debtors turnover ratio. Then inventory holding period is given. Total asset turnover ratio is given. Net profit ratio is given. Return on net worth, which is nothing but your return on equity, is given. Debt to asset ratio is given. Interest coverage ratio is given. They're saying compute all the ratios for Amar Limited and give your comments by comparing it with the industry norm. Calculate the operating cycle time for the company. Also comment if the operating cycle time for the industry is 38 days. So we'll have to first calculate these ratios for the company, then compare those numbers with these numbers, then give our comments. That is part one of the company. So first, let's look at asset test ratio. How do you calculate asset test ratio or a quick ratio?
Quick ratio.
Yeah, quick ratio.
So current assets minus
current asset minus stock minus prepaid
minus
expense
prepaid
upon current liability. Okay. So first, let's calculate the quick ratio. So quick ratio is current asset minus stock minus prepaid expense. So what are my current assets? These three numbers. From this, I will remove stock and prepaid expense, which means my numerator will become cash and debtors. Any doubt with this?
Yes.
So I'll look at the solution. Solution tells me the numerator is nothing but D5 and D6. So D5 and D6 is nothing but cash and debtors. Then denominator is current liability. Current liability will consist of your creditors, bills payable, and other current liabilities. So that's nothing but B7 to B9. So that's B7 to B9. Divide the two, you get a quick ratio of 1. So for your company, the quick ratio is 1, but for the industry, it is 1.5. What does a quick ratio tell you? It basically talks about your short-term repayment capacity. Will you be able to pay off your current liabilities on time or not? So again, this company seems to be struggling because their ratio is only 1. But other people in the same sector, the peers, the competitors, they are in a much more better position because they have a ratio of 1.5. So the liquidity position is not that great. They seem to be struggling in terms of short-term liquidity. Any doubt with the asset test ratio?
Yes.
Then the next ratio that we need to calculate is your debtors turnover ratio. How do you calculate debtors turnover ratio? Credit sales upon your receivables. Okay, so I need credit sales, I need receivables. So let's look at credit sale. So that's my credit sale. So credit sale is nothing but C15. So credit sale is nothing but C15 divided by receivables, which will consist of debtors and bills receivable. So let's look at debtors and bills receivable. Over here, I just have debtors, which is nothing but D12. So I go to D12. So that's my debtors. I divide the two. I get a debtors turnover ratio of 9.1, which means my customers are turning around 9 times in a year. But for the sector, they're turning around only 5 times. As a company, do you want your debtors turnover ratio to be high or you want the number to be low? Again, remember the relationship between debtors turnover and debtors collection.
Debtors turnover should be high.
Debtors turnover ratio should be high so that debtors collection period is low. So over here, you are in a better situation compared to your peers. So what I've done is I've just calculated the debtors collection period over here. So my debtor collection period will be nothing but 365 upon debtors turnover ratio, which is nothing but 40 days. And if I do it for the industry, then for the industry, it's 365 upon 5, which is nothing but 73 days. So my customers make a payment in 40 days, but my peers, their customers make a payment to them in 73 days. So I get the payment quickly compared to my peers. Any doubt with debtors turnover ratio or debtors collection period?
No, sir.
Okay. Then the next one is inventory holding period. How do you calculate inventory holding period? Inventory holding period will be nothing but 365 divided by inventory turnover ratio. And inventory turnover ratio is nothing but COGS upon stock, which means the formula will become 365 divided by COGS into stock. So that's how I'll calculate my inventory holding period. 365 divided by COGS into stock. So what I need is cost of goods sold and what I need is stock or inventory. So cost of goods sold is given over here. So this is my cost of goods sold. They've already totaled it up and given me the total. So this is my total. This is my cost of goods sold. I also need inventory, which is nothing but stock. So that is also given in the balance sheet. So I know my cost of goods sold. I know my stock. If I divide, I'll get my inventory holding period. So let's look at your inventory holding period. So I've first calculated the inventory turnover ratio and then I've calculated the inventory holding period. So if you look at the inventory holding period is nothing but 148 days. So you're holding the inventory for 148 days before you are able to sell off the inventory to your customer. But if you look at your peers, your competitors, they are able to do that in 90 days. So do you think you are in a better position or worse off position?
Worse.
Worse, because you are able to sell goods in approximately 5 months. Your peers are able to sell it off in 3 months. So again, you take a much more longer time to sell the goods. And if you sell goods after 5 months, of course, what will happen is you might end up having liquidity problems, because of which maybe your quick ratio and everything is on a lower side. Okay. Then let's look at the total asset turnover ratio. How do you calculate total asset turnover ratio?
Total asset by sale.
No, it's the reverse, inverse.
Sorry.
It's sales upon total assets. So total asset turnover ratio is nothing but sales upon total assets. So I'll calculate my sales. So I'll take my cash sale, credit sale, and I'll take my total assets. So total assets are already given to me. This is my total asset. So I know my sales, I know my total assets. I'll get my total asset turnover ratio. So total asset turnover ratio is sales upon assets. And when you calculate it, you're getting a ratio of 1.4, which means for every 1 rupee of asset that you have, you can generate a sale of 1.4 rupees. But look at your peers, they can generate a sale of 2 rupees.
Right.
So do you think you are more efficient or your peers are more efficient? Peers are more efficient. So it talks about inefficiency. So you'll have to look at measures through which you can increase the efficiency. So asset turnover ratio, I'm not that efficient compared to my peers. Any doubt with asset turnover ratio?
No.
Then let's look at the next one, which is your profitability ratio. So net profit ratio is nothing but net profit upon sales, which is nothing but PAT upon sales into 100. So that's my net profit ratio. So I need PAT. PAT is given to me in the question. So that's my profit after tax. I need sales. So sales are given to me. That's cash and credit sale. So I know the numerator. I know the denominator. I can calculate the ratio. So sales, we know. Net profit, we know. So I get a net profit ratio of 2%. But my peers have a profitability of 3.5%. So again, I'm struggling as far as my profits are concerned. Managing cost is concerned. I'm not able to control my cost. Any doubt with the net profit ratio?
Yes.
Then let's look at your return on net worth, which is nothing but your return on equity. So how do you calculate your return on equity? It is nothing but PAT upon shareholders fund into 100. So again, you know your PAT, which is this number. You know your shareholders fund, which is nothing but your share capital plus reserves and surplus. So you know your numerator, you know your denominator. You can calculate your return on shareholders fund or return on net worth. So net profit, you know, net worth, you know, when you multiply, you get a return of 4.62%. So you're saying that you are generating a return of 4.62% for your shareholders, but your competitors are generating a return of 10.5% for your shareholders. Again, it just says that you're not able to generate enough returns and a lot of things need to be changed as far as managing the company is concerned. Any doubt with this?
No.
Yep. Any doubt with this? Okay, fine. Then let's look at the next one, which is your total debt to total asset ratio. So total debt to total asset ratio, the name itself suggests that total debt to total asset, what will be the formula? It will be total debt upon total asset. So what's your total debt? Total debt is nothing but this. So that's your total debt. I'll take my debentures, creditors, bills payable, current liability. And what are my total assets? My total assets are these. So I'll take total debt divided by total assets and I'll get the number. So total debt upon total asset is 37.66. I don't want it to be in a percentage terms, then I can just remove it. And I can just calculate it as a normal number. Similarly for this one. Yeah. So my total debt to asset is nothing but 0.37. But for my peers, it's 0.6. It just tells me that I'm taking less of a debt compared to my peers. My peers are taking a higher amount of debt and they're taking a lot of risk, but I'm maybe a risk averse company. Therefore, I want to take less amount of debt. Any questions on the debt to asset ratio? And then finally, let's look at the last one, which is your interest coverage ratio. So how do you calculate your interest coverage ratio? Interest coverage ratio is nothing but EBIT upon interest. So EBIT upon interest. So if you look at your EBIT is given in the question, earnings before interest and tax. And I need to divide it by interest. Interest is also given in the question. So I know the numerator, I know the denominator, I'll get my answer. So my interest coverage ratio is 5. My peers have an interest coverage ratio of 8. Again, it's poor. It's not at par with my peers. So I'm struggling. I may end up defaulting. I may not pay the interest on time compared to what my peers have.
Right.
Yep. Any doubt with the first part before we look at the second part? Second part was calculate operating cycle time. Now, how do you calculate operating cycle time? We did this in the earlier session. Operating cycle time is nothing but inventory holding period plus debtors collection period minus creditors payment period. So I need inventory holding period, debtors collection period, and creditors payment period. Now, out of these three, I've already calculated inventory holding and debtors collection. My debtors collection period is this. My inventory holding period is this. So I know my debtors collection period. I know my inventory holding period. So I'll have to calculate my creditors payment period. How do you calculate your creditors payment period? $365 upon creditors turnover ratio. And creditors turnover ratio is nothing but credit purchase upon your payables. And payables consist of creditors and bills payable. So what you need is credit purchase, creditors, bills payable, and then you can calculate your creditors payment period. So let's look at creditors and bills payable. Creditors and bills payable is given in the balance sheet. So I know my creditors, I know my bills payable. So I know this part, which is creditors and bills payable. Then let's look at credit purchase. What do you purchase on credit? You purchase material on credit. So material cost is given to me, which is 83,60,000. So I know the numerator, I know the denominator, I can calculate my creditors payment period. So my creditors payment period comes to 134.47 days. And finally, if I calculate my operating cycle time is coming to 54 days. Industry average is 38 days. What is operating cycle time? It is the time which is taken for cash to get converted back into cash. So if money is going out of your pocket, it is coming back in 54 days. But for your peers, if money is going out, it is coming back in 38 days. So what is better? Money should come back in 38 days or money coming back in 54 days?
38.
38 days. So you are struggling. Your money is blocked for additional 16 days, which is not good. And this again will impact your liquidity, profitability, and everything. So again, operating cycle time is poorer than the industry, and you're taking more time to convert cash back into cash. So any doubt with this question on ratios? Yeah, any doubt till here?
No, sir.
Okay. Then let's look at the last one, which is comparative statement and a common size statement. Any idea what is a comparative statement or what is a common size statement?
Comparative statement we got yesterday in balance IA.
Okay.
So comparing balance sheets of two time periods of equal length.
Fine. Okay. So in a comparative statement, you look at two time periods and you compare them. But what is the logic of comparing two time periods? So let's say I have sales of year one and year two, and I compare them. What will it tell me? How will it help me?
The financial position of a company overall.
I didn't get you. Can you just say it again?
The financial position of a company overall.
Financial position of a company. Fine. So when I'm looking at, let's say, a comparative statement, I could have a comparative income statement and I could have a comparative balance sheet statement. So when I'm looking at a comparative income statement, I'll have data for 2 years which deal with my income statement. When I'm looking at a comparative balance sheet, then I'll have data for 2 years which deals with my balance sheet data. So over here, they'll give me assets and liabilities. Here, they will give me revenues and expense. So let's take a hypothetical example and try and understand how do you make a comparative income statement and then how do you make a comparative balance sheet. Let's say I'm looking at a comparative income statement. They've given me data for, let's say, year 21 and year 22. I've got data for 21. I've got data for 22. So first, let's say they'll give me sales. So let's say sales over here is 10,000. Over here it is 15,000. Then I'll reduce my cost of goods sold. I'll get my gross profit. Then I'll reduce other operating expenses. I'll get operating profit. Then I'll reduce, let's say, my interest cost. I'll get PBT. I'll reduce tax. And finally, what I'll get is profit after tax. So let's say they give you this data. They give you cost of goods sold. Let's say it is 5,000 over here. So you get a gross profit of 5,000. Other operating expenses, let's say 2,000. So this becomes 3,000. Interest is, let's say 1,000. So this is 2,000. Let's say this is 1,000 and you get a profit after tax of 1,000. Similarly, they'll give you data for the next year. Let's say data for the next year is sales of 15,000. Cost of goods sold is, let's say, 10,000. Gross profit is 5,000. Other operating expenses 3,000. So this will become 2,000. Interest is, let's say, 500. So this will become 1,500. Let's say this is 750 and I get 750. So when I'm making a comparative income statement, I'll first make my income statement. So I'll first make all this. So I'll first have my sales, cost of goods sold, gross profit, operating expense, operating profit, EBIT, interest, PBT, tax. Then I'll write the data for the 2 years, that's year 21 and year 22. Once this is done, then what I'll do is I'll calculate absolute change, and in the next column, I'll calculate percentage change. So in one column, I'll calculate absolute change. And in the next column, I'll calculate percentage change. So first, let's look at absolute change. My sales from 10,000 have gone up to 15,000. So what's the change in sales? The change in sale is 5,000. Any doubt with absolute change?
No.
Then how will I calculate a percentage change? Percentage change will be nothing but absolute change upon the base year figure, which means it will be nothing but 5,000 upon 10,000, which is nothing but 50%. So that's my percentage change. And I'll do this for each and every line item. I'll do it for cost of goods sold, gross profit, and every line item. Similarly, as far as my percentage change is concerned. So comparative statement will basically tell you what has happened in the company over the last 2 years. And if you're looking at a comparative income statement, it will basically tell you what is happening to your income, what is happening to your expense. Are you efficient at the factory level or inefficient at the factory level? What is happening to your final profit, so on and so forth. So any doubt with the comparative income statement?
No.
Okay, so let's take a look at an example. So over here, I have a comparative income statement where they've given me data for 2 years, 2020 and 2021. They've given sales. Then I've got my cost of goods sold. They've given me gross profit. They've given me other expenses. And finally, my operating profit. So when I look at my sales have increased by 50%. So my sales have increased by 50%. If I look at my cost of goods sold has gone up by only 48.9%. As a result, my gross profit has increased by more than 50%. So my income is increasing by 50%, but my production expense is not increasing by 50%. As a result, my gross profit, which talks about profitability in the factory at the production level, that is increasing by more than 50%. Finally, I take care of the other expenses and everything. And if I look at my operating profit is increasing by almost 68%. So this company seems to be doing well. The sales are increasing, but the profits are increasing by a larger percentage because they're somehow able to manage their costs. They're able to control their cost. Any doubt with the comparative income statement? So you can first calculate the absolute change, then the percentage change.
No doubts.
Okay. So just like you have a comparative income statement, you can also have a comparative balance sheet. So again, let's take an example of a comparative balance sheet. So again, let's say they give me data for 21 and 22. So let's say I'll have non-current assets, I'll have current assets, then I'll have shareholders fund, non-current liability, current liability. Let's say non-current assets were 5,000, current assets were 2,000. So total assets were 7,000. My shareholders fund is 2,000. Let's say this is 3,000. This is 2,000. So again, I get 7,000. Balance sheet has to tally. So the asset side and the liability side will be the same. Then let's look at the data for the next year. Non-current assets, let's say, have doubled. Current assets have become 5,000. 15,000. Let's say this is 10,000. This is still 3,000. This is 2,000. Put together 15,000. Again, what I'll do is I'll first calculate absolute change and then I'll calculate percentage change. So when I calculate an absolute change, when I look at my non-current assets from 5,000 have gone up to 10,000. So on an absolute basis, the change is 5,000. What will be the percentage change for non-current assets?
Percentage in non-current.
Yeah, non-current assets. How much?
3,000 by 2,000. Sorry, what?
From 5,000, it has become 10,000. So absolute change is 5,000. So what's the percentage change?
Okay, I was calculating for this. So 50%.
50%. How do you calculate percentage change? Absolute change upon the base year figure. which means 5,000 upon 5,000. How much?
100%.
100%. Similarly, if you look at the current asset, from 2,000, it has become 5,000, which means absolute change is 3,000. And the percentage change will be 3,000 upon 2,000, which is 150%. And again, you'll do it for each and every line item. Yeah, any doubt till here?
No, sir.
Okay, so let's look at an example. So again, I've got a comparative financial statement, and this deals with a balance sheet. So in a balance sheet, what I'll have is I'll have fixed assets, I'll have tangibles, I'll have intangibles, then I'll have other non-current assets, which is investments. I'll have current assets, I'll have current liabilities, I'll have share capital and reserves and surplus, I'll have my long-term debt, which could be debentures and public deposit. So they've given me all this information. So I'll first make my balance sheet. So I'll make my balance sheet. So my balance sheet has to tally. So the asset side and the liability side will be the same. And then I'll copy paste the data. So I'll first write the figures for 2020. Then I'll write the figures for 2021. And then I'll calculate absolute change and percentage change. So just go through it and let me know if it is fine, you're struggling, you want me to explain any number, just go through it. Take 2-3 minutes, 5 minutes, let me know.
So what is net block?
What is?
Net block.
Net block is nothing but gross block minus the depreciation. So net block, let's take an example. Let's say you bought a car for 10 lakhs and you use the car for a year, because of which depreciation is 2 lakhs. So finally in your books, the asset, the car is worth 8 lakhs. So 10 lakhs is the gross block. That is the value at which the asset was purchased. 2 lakhs is the depreciation and 8 lakhs is your net block.
Sir, could you scroll down a bit? So what is OX, EXP, OSXP?
Which
Operating
one?
row number 30.
This one? OS? Outstanding.
Outstanding. Okay.
Outstanding expense, which means expense which you haven't paid. So let's say salary which is not yet paid, electricity bill which is not yet paid, telephone bill is not yet paid. So it's a liability because I'll make a payment and I'll make a payment in the next 30 days or so.
Okay.
So it's a short-term liability, it's a current liability. So that's an outstanding expense. Yep. Once you're done with this, let me know.
Yeah, I'm done.
Okay, fine. I think they've posted the feedback form. If you could just fill it up. Yeah, they posted it. Can you just fill it up, Harshita?
Yes, I'm doing.
Yeah.
Done, sir.
Okay, fine. So any doubt with comparative income statement or a comparative balance sheet before we look at common size?
No, sir. No.
Okay, then let's look at common size. Any idea what is a common size statement?
Size refers to the time period?
No, not the time period.
Then I don't know, sir.
Okay. So you can again have a common size income statement. And you can have a common size balance sheet. Now, common size income statement and balance sheet is typically used when, let's say, you're comparing two companies, but they're of different size. Let's take an example. Let's say I want to compare a company like TCS, which is into IT business, with a young startup IT company, but a young startup. Now,
Right.
TCS has sales of, let's say, 10,000 crores. This company has sales of 10 lakhs. TCS has, let's say, profit of 4,000 crores. This company has a profit of, let's say, 6 lakhs. Now, if I just look at absolute numbers, which is 10,000 and 4,000 and 10 lakh and 6 lakh, I'll end up saying TCS is a better company. But if I look at it in terms of percentage, what is my profitability for TCS? TCS is generating a profit of 4,000 on a sale of 10,000, which means your profit ratio is nothing but 40%. But when I look at this company, the new one, the new company is generating a profit of 6 lakhs on a sale of 10 lakhs, which means their profit is 60%. So now my view about the young company changes, and I'll say, no, young company is more profitable compared to TCS. But of course, on an absolute basis, TCS is earning 4,000 crores, you're earning only 6 lakhs, but you are more efficient compared to TCS. So when you look at a common size, or basically a common size is looked at when the sizes are different. You don't want to look at absolute numbers, you want to look at percentages. So in a common size income statement, what you'll do is you'll calculate everything as a percentage of sale. So over here, you calculate everything as a percentage of sale. And in a common size balance sheet, you calculate everything as a percentage of total assets or total liabilities. Let's take an example. Let's say I've got two companies, X and Y. Sales are 10,000. Then I've got cost of goods sold of 5,000. Gross profit is 5,000. And let's say I've got other operating expenses of 2,000. And finally, I've got a profit of 3,000. Then I look at company Y. Company Y is a bigger company. Their sales are 1 lakh. Cost of goods sold is 60,000. So gross profit is 40,000. Their operating expenses, let's say 25,000. And profit is 15,000. So now if I just look at absolute numbers, I'll end up saying that Y is a better company because they're generating a profit of 15,000 compared to X, which is generating a profit of only 3,000. But when I look at a common size income statement, then what I'll do is I'll calculate every line item as a percentage of sales. So when I make a common size income statement for X and Y, I'll assume sales to be 100%. And then I'll calculate everything as a percentage of sales. So let's look at X. If 10,000 is 100%, then 5,000 is how much? 5,000 will be 50%. Okay. Again, let's do the same thing with gross profit. If 10,000 is 100%, so 5,000 is how much? 50%. 2,000 is how much? 20%. And 3,000 is how much? 30%. So in a common size income statement, you take your sales as 100% and you calculate everything as a percentage of sales. I'll do the same thing for company Y. I'll say if 1 lakh is 100%, then 60,000 is how much? That will come as 60%. 40,000 is 40%. 25,000 is 25%. And 15,000 is 15%. So now my view about the companies could change. When I look at company X, I will say company X has a gross profit of 50%, but company Y has a gross profit of only 40%. But of course, in absolute numbers, this company has a profit of 40,000, this company has a profit of only 5,000. But when I look at everything in terms of a percentage, my view about company X is changing. Similarly, when I look at the final profit, which is my net profit, again, net profit for company X is 30%, but for company Y is only 15%. So company X is more profitable compared to company Y when I'm looking at it in percentage terms. Absolute basis, you will end up saying, no, this is better and this is less. So this could be misleading a number of times when you're looking at two different companies in the same sector, but the size is different. One is a big company, another one is a small company. So instead of looking at absolute numbers, it makes sense to look at percentages. So any doubt with a common size income statement?
No.
Okay, so let's look at an example. So over here, I've got two companies, X and Y. So they've given me sales. Then they've given me cost of goods sold. Then I have operating profit. Then I've got EBIT. And finally, I've got my PBT or profit. So if I look at my PBT, then Which company is more profitable in absolute numbers? Absolute numbers, the second one is better because they have a profit of 5,15,000 compared to the first one, which has a profit of only 4,15,000. But when I look at it in terms of percentage, my view could change. So again, the same thing. I'll assume sales to be 100%. So I'll say, okay, if this number is 100%, which is nothing but 10 lakhs. So if 10 lakhs is 100%, then I'll calculate everything as a percentage of that. So 1,50,000 is how much? 15%. 3 lakh is how much? 30%. 2 lakh is how much? 20%. Cost of goods sold is 5 lakh. So that makes it 50%. Operating profit is 4 lakh, which makes it 40%. EBIT is 4,25,000, which makes it 42.5%. And PBT is 4,15,000, which makes it 41.5%. Do the same thing for Y Limited. Take sales as 100%. So if 15 lakh is 100%, then how much is 2,50,000? So that will come as 16.7%. Any doubt with the calculation?
No.
I'll do the same thing for each and every line item. And then what I actually figure out is that this company is earning a profit of 41.5%, but the second company is earning a return of only 34.3%. But on an absolute basis, definitely this company is earning more profit compared to the first company. But in terms of percentage, first company is better. So any doubt with the common size income statement?
No.
Then we could do the same thing for a common size balance sheet. So when I'm looking at a common size balance sheet, again, let's have got two companies, X Limited and Y Limited. Here they'll give me data for the balance sheet. So let's say I'll have non-current assets, current assets, I'll have total assets, then I'll have shareholders fund, and let's say I just have long-term debt. That's it. So I'll get total of liabilities. Let's say for X Limited, non-current assets are 50,000 crores. Current assets is another 50,000 crores. So this makes it 1 lakh crore. Shareholders funds is 80,000 crores. Debt is 20,000 crores. So again, balance sheet has to tally. So this is again 1 lakh crore. Company Y is a young company, so their balance sheet is not that strong. So let's take lower numbers. Let's say non-current assets are 10,000. Current assets are, let's say, 5,000. So this becomes 15,000. When I look at my shareholders funds, let's say shareholders fund is 10,000, 5,000, 15,000. So when I'm looking at a common size balance sheet, in a common size balance sheet, I'll assume total assets and total liabilities to be 100%. So when I'm making a common size balance sheet, this will become 100%, which is the total of the assets or total of the liabilities. So now I'll say, if I'm looking at company X, if 1 lakh is 100%, then 50,000 is how much? 50%. This 50,000 is how much? 50%. This 80,000 is how much? 80%. And this 20,000 is how much? 20%. Then again, I'll move to company Y. If 15,000 is 100%, then 10,000 is how much? 67%. 5,000 is how much? 33%. Same thing over here, 67%, 33%. So companies are of different size. Don't look at absolute numbers, convert everything into percentage and then take a decision. That could be a more realistic and a better decision that you take. Any doubt with a common size balance sheet?
No.
So this is the last example. So you have a common size balance sheet where they give you data for X and Y Limited. So they've given you owner's fund, which is your shareholders fund. Then they've given you borrowed fund. Then they've given you fixed assets. They've given you investments. They've given you current assets. They've given you current liabilities. So again, over here, you'll take the total as 100% and you'll calculate every line item as a percentage of that. Similarly, over here, you'll take the total as 100% and you'll calculate everything as a percentage of that. So any doubt with a common size balance sheet? Any doubt with whatever we've done today? So with this, I think we're done with the syllabus. Yeah, we're done with comparative, we're done with common size.
No doubt.
Any doubt, any query with whatever we've done in the last 4 sessions?
So no query related to concepts, but I mean, individual concepts are clear, but when it comes to aggregating all of them into a single question, it's tough. So for preparation for TE, I just wanted to have some guidance.
Again, just go through whatever is there in your async content and whatever we've done in the class. So if you have prepared for your IAs and you know the basics, then I don't think your term and exam should be a problem, because your term and exam will have 3 questions and the total is, I think, 60 marks, right? Yeah. So you'll have 3 questions of 20 marks and it'll be for 60 marks put together. And let's say they could tell you, you could have a question like, explain any 4 efficiency ratios. So you could explain a fixed asset turnover ratio, current asset turnover ratio, in that debtors, inventory, total asset, maybe creditors turnover ratio. So pick up any 4 ratios, write the formula, explain it in your own language, and take some numbers and explain it. So let's say when you're explaining a fixed asset turnover ratio, you'll say fixed asset turnover ratio is nothing but sales upon fixed asset. Then you'll say, okay, what does it mean? It means that for every 1 rupee of investment that you do in your fixed asset, how much sales are you generating? And companies would like to have this on a higher side. Take some number like I've taken over here, 350 upon 100, 3.5, take it for, let's say, X and Y, and then do a comparison. So again, if you've understood the concept, I don't think the term and exam should be a problem. You can write it in your own language.
Okay. And can we expect any numerical based questions?
You could. So again, there will be some questions where Excel is allowed. So they'll give you an option to upload an Excel. So there you can upload an Excel. There'll be some questions where you just have to do an explanation and just type it, where no Excel is required.
Okay.
Yeah. Anything else? Any other doubt? Otherwise, we're done.
No other doubts.
Okay, fine. All the best for your exams.
Thank you, sir.
Okay, bye. Take care.
Thank you, sir.